Welcome to the Daily Update, where I'll go over the action in the market for Wednesday, June 28th, and then we'll see how things look for Thursday, June 29th. Wouldn't you know that after I recorded and edited and uploaded yesterday's video, I received notice that the appointment that I was supposed to have on Thursday was canceled. So I have been able to prepare and get the video ready at more of a normal time. We had a slight down day. It was probably a little more negative than positive, but we're still seeing some improvement in our charts. The broader market seems to be showing a little bit of improvement, where the bigger parts of the market, they're showing a little bit of weakness. We saw growth outperform value, and the market is really indecisive right now. If you think we're looking at all of our charts and kind of coming to a muddled conclusion, the rest of the market is seeing the same thing, and they're like, we're not really sure what's going to go on here. We're also seeing a decrease in volume, so some of the program trading based on algorithms, that can really shift things higher or lower, so we saw a really choppy day overall. Before I get started, please know there's a PDF of the slides and charts in the description below the video that you can use. I do have a private Facebook group that you're welcome to join. There is a new poll posted that you're welcome to take part in. That is on the YouTube community tab. I'm trying to really keep a close eye on those to get rid of any of the crazy comments or bot comments. But please feel free to put a comment in there if you have something that you would like to say. I also post videos on Rumble in case you can't find me on YouTube. So right at the open, we did have a gap lower open. We went down to the daily pivot at 43.66. Then prices climbed back to the unchanged level, and we actually went positive for a little while, but we set the high at that point at 43.90. As the day went on, we fell back below the unchanged level and found support at the daily pivot before closing slightly negative on the day. We were down 0.04%, pretty much unchanged, but this goes in the books as a down day, and some of our indicators are based on the closing value, so that has shifted a couple of our indicators to looking a little more negative. Volume was below average. You could also see that as somewhat positive, where on the up day that we saw yesterday, that was also on below average. That was a warning sign that we're chopping around and then ended up closing lower. That can be seen as positive after today's action. The technicals, we're still having a positive backdrop overall. There are some positive areas. There's some areas that are showing improvement, but there's still some negative things that we need to be aware of. Inflation and interest rates, which are producing growth concerns, that's in the background. And we're also keeping an eye on what's going on in Russia just to see if that escalates and then has some kind of an impact on the stock market. What are some comments that we can make? Fed Chair Powell, who was in Portugal, he didn't really say anything that was all that surprising, reiterating what he had already said before, and he doesn't think that core inflation will be back down to 2% until 2025. He also indicated that policy rates have not been restrictive long enough, so they want to keep rates higher for longer, and that more rate hikes are needed, and that the idea that there could be consecutive rate hikes should not be taken off the table. This is pretty much known information, and the market knows this already, so it didn't really catch the market off guard. On an intermediate term basis, we're still keeping an eye on those oscillators. We're rolling over negative with those, and this measures momentum, so the fact that they are rolling over is a bit of a concern. The dollar was up and interest rates were down. We still have all the yield curves that remain inverted. Sentiment is still extreme positive. It had ticked up to 77 from 76. Our trend is still positive, but because of the down day, the green line did turn down slightly. The ADX is dropping below its moving average, but both of them are still above 20. I put our bias back to mixed. Even though we had a down day, we had a solid up day yesterday, so I'm kind of taking the two together. And then our momentum continues to be mixed to more negative since we saw a lot of down days in a row. Looking at the economic reports, we had the weekly MBA Mortgage Applications Index. It came in up 3%. Last time it was up 0.5%. Advanced international trade in goods came in minus 91.1 billion, less than the 97.1 billion that they were down last time. Advanced retail inventories were up 0.8%. Last time they were up 0.3%. Wholesale inventories were down 0.1%, and last time they were down 0.3%. Then I'm switching around where I post the economic charts. I don't have an awful lot of charts to show you. Looking at the mortgage applications, this is the composite index against the 30-year mortgage rate, where we saw a little bit of a tick down in the most recent reading. This is the refinance index, also declined slightly. The purchase index also declined just a little bit. We're seeing a little bit of an uptick with the refinances, and we're pretty much flat on the purchases. Then this is the other chart that I tried to show you, advanced international trade in goods. This is, if you can ever think of one of the typical government charts that were provided, isn't this just about as helpful as you can imagine? We have one little dot here right in the middle, no data on here, and I wasn't able to find any other charts based on this. Looking at some Isabel Net blog charts, they're seeing buybacks slow down a little bit this past week. They're still happening, but not as strong as they had been. And then discretionary, which means you can pick and choose, you can decide when to get in, when to get out. And then they compare that with a systematic approach to investing. The advance that we saw recently caught a lot of people off guard. It didn't feel like it was supposed to go higher, but yet it went higher anyway. So if you used more of a systematic approach, you're seeing that you're outperforming right now. Where discretionary takes emotions into account, where it's still doing okay, but it's really starting to underperform. Then we're looking at the change in liquidity, and this is what amount of money is out there that can be used to go in or is coming out of the market. And then right here where the Fed jumps in and takes action following the Silicon Valley Bank failure, where the black line is the S&P 500 and then the red line is the liquidity index. And when we see liquidity going up, that tends to be more positive for the market. Then, are you more likely to increase or decrease your equity exposure in the coming days or weeks? Equities are stocks. It's fallen down a little bit, but it's still coming in at 36%. Looking at the Morgan Stanley non-PMI leading earnings indicator, and then comparing that with the actual earnings, that's the blue line. The dashed orange line is what Morgan Stanley thinks will happen, and then the yellow line is the overall consensus. The thing to take away from this is looking forward, we are seeing some improvement where the blue line continues to decline. Then looking at the equity positioning where we're above zero and advancing, so more people are starting to get into stocks. This is a chart that I usually go over in the weekend video where we look at the smooth U.S. recession probabilities. We're below the black line, and we really only start to get nervous if we go above the red line, and we're far away from that right now. Looking again at discretionary positioning, folks that use their emotions and logic to try to determine when to get in or out, and then comparing that with ISM manufacturing, the purple line is ISM, and that continues to decline. Well, the green line is discretionary positioning, and that is actually going up. As this line is going up and people are getting more into stocks, that will suggest that they are anticipating a soft landing, and we're also seeing that when compared to the other chart that we look at later on. Then it says another sign this bull market isn't over yet. This comes out from Carson. When we've had a negative year before, like we did in 2022, and then it's up over 10%, and we compare next June with this June, the returns tend to be very good overall. Getting into our analysis and charts, here's the intraday chart where we gap lower down to the pivot point. We pretty much set up a good base right here. We also set the low for the day. The market tried to rebound, got a little bit above the unchanged level. Then we stalled out, came back, went negative again, came down to the daily pivot again, bounced up a little bit, back down to the daily pivot, and then saw a little bit of buying going into the close, making it so that we were down just by a very small amount. Here's the intraday chart, where the initial overnight session had been a little bit negative. We saw some improvement after Europe opened, and then going into the open, that's when the futures turned more negative. We bounced around during the day, and we're seeing a little bit of improvement now in the initial overnight session. Growth is outperforming just a little bit. Value was down slightly. So on a closing basis, growth was up 0.12%, where value was down. It was up more with the mid caps and also up more with the small caps. Looking at our growth to value ratio, we're seeing some improvement here, where we were able to get above the unchanged level and then stay positive for the rest of the day. Now, yesterday, this was a bit of a concern. We were seeing a lot of decline in this chart, but now it looks like it could be showing some improvement. Looking at sentiment, the Ulster Index was pretty much flat, although it ticked up just a little bit. And then our VIX chart shows we declined with the line chart as well as the bar chart, and volatility of the VIX is really starting to drop off as well. Here's a chart that I usually only show in the deep dive video. It's just showing that our long-term moving average of the VIX is declining and we're dropping below 20. The equity put call ratio really didn't change all that much. We are declining as stocks have been going up. Then longer term, this is still turning more positive. We're seeing the 253 period simple moving average continue to fall, which could be positive for the market. The VIX to move ratio still continues to decline below a declining moving average. With this other measurement that we use to show fear, we're also showing that fear is subsiding. We also tick down just slightly with our other fear chart. Folks are still favoring more of a risk-on posture, and we saw that tick up slightly. Our advanced decline line studies, we were down just a little bit based on price, and we were flat to slightly down based on volume. This is also encouraging. We're seeing a continuation of breaking out of the new highs. That's helping our 5-period moving average a little bit, even though it's starting to roll over, and we were flat with our 10-period differential. We're still above zero with the advanced decline ratio, even though the blue line and the red line declined slightly. Accumulation distribution has now tried to get slightly back above the moving average. Our NYSE cumulative advanced decline line did tick up slightly, so that's some more broader range improvement, and we also saw the regular NYSE advanced decline line tick up. When we look at this other measurement of the NYSE advanced decline line, we're still back above this upward sloping trend line. When we look at common stock based on price and volume, we did see a little bit of improvement. Then broader range with the NYSE, we were flat. The S&P 500, we declined a little bit with the mid caps and the small caps, where the mid caps still remain above the moving average, as small caps continue to be below the moving average. Keeping an eye on our trend, the black line has just barely crossed below the moving average. The green line did decline, however, both are above 20. Our shorter-term ADX also shows that we have a weakening shorter-term trend. The green line also declined slightly. Volume continues to drop off as the market is really indecisive right now. Short-term, we're still above the August 2022 highs and trying to bounce up off of that. You can see on the bottom where volume really dropped to below average. Looking at our 20-period double and triple exponential moving averages, now they may be acting as overhead resistance. When we look at our regular 20-period moving averages, we're still above that and could call this as support holding so far. We saw a little bit of a tick down with our 20, 50, and 200-period moving average study. The force index declined a little bit but is still above zero. The stochastics showing a little bit of improvement with the short term, turning back up in the intermediate term, but still declining in the long term after giving us an extreme positive reading. Intermediate term, we're still looking a little bit better with the balance of power. We're above the dashed line and advancing. Looking at our double and triple exponential moving average based on 50 periods, for right now, it looks like the double exponential moving average has provided support, but it also looks like the triple exponential moving average could be providing overhead resistance. Then looking at our moving average tree, coming down almost to the 20 and then bouncing back up off of that. The go, no-go system is still more neutral with the lighter colored blue bars. The TTM squeeze, though, still continues to decline. We're in the second standard deviation now, so we've been able to work off this extreme positive reading. The fact that we're above the midpoint is also positive. The PPO continues to be positive in the long and intermediate term. We're pretty much flat in the short term, but still positive. The Arun didn't see a change as we're seeing sellers decrease, but we're also seeing buyers decreasing. With the McClellan oscillator based on the S&P 500, we did tick down, but we remain above zero. This is a little more positive. The NYSE broader range McClellan oscillator actually showed an advance above zero. So our summation index based on price ticked up just slightly, as well as volume, even though it was pretty much flat to slightly higher. The summation index based on price is continuing to advance, but based on volume, it continues to decline, so we're not seeing confirmation here. The Swenlin trading oscillator based on price and volume did improve, but both are below zero. The Elder Impulse system remains at neutral for the S&P 500. The PMO is right about on top of its moving average. When we look at it based on price, they're pretty much on top of each other, but we are declining based on volume. The PMO steady ticked down just slightly with the PMOs that are rising. We're also declining with the buy signals. We were pretty much flat with the PMOs that are above zero. The parabolic SAR system still remains negative with the dots on top. The slope oscillator, which is our touchiest oscillator, continues to be negative. The MACD has also dropped below its moving average and is also negative. So when we look at all of our oscillators, we're turning more negative across the board, where we're pretty much flat with our longer term oscillators. The BPI continues to hang in there. Even with the down day, it ticked down slightly, but we're still holding up fairly well. The NYSE bullish percent index actually ticked up just slightly and is above 50. The Chaikin money flow ticked up a little bit and continues to be positive, where the Chaikin oscillator, even though it's showing some improvement, is still below the dashed line. The money flow index is above 50 and advancing, where the ultimate oscillator did cross back above 50, so that's turning more positive. The vortex turned up slightly with the green line and we were flat with the red line. The RSI is still above 50, even though we were flat. We were also flat based on the 9 period and also remain above 50. On balance volume, even though it declined, is still above the moving average. The Pring bottom fisher continues to generate a buy signal. And we saw a little bit of a tick down with our 200 period moving average study for the S&P and also a tick down with our 50 period moving average study. And here's another look at that same chart. Looking at our Fibonacci and line studies, we're far away from the lines on the quadrant study, so I'm not showing that chart for right now. We're still above this 100% retracement level, which could be acting as support. If we start to fall, we will watch that level to see if we break through and then close below that level. Longer term, we're also above the 61.8% retracement level and still holding above support. And we're also holding above support when we look at the 20 period simple moving average of the open, high, low, close. The green line is the high, and we remain above that currently. Our different charts showing a little bit of improvement with the Heiken Ashi. Also looking more positive with the Kegi. Still looking positive with the Renko, but looking a little more negative with the 3-line break. Different indexes. We ticked down slightly with the equal weight index. Then the ratio between the S&P 500 and the equal weight index did tick down slightly. We are seeing some really good improvement here. We have the Dow up on top, and then the transports are showing some strength right now. That could be positive, but in the shorter term, we're seeing where utilities are showing weakness. And the transports are really showing some improvement, but they're still slightly underperforming the Dow. Looking at discretionary versus staples, discretionary was up on the day where staples were down, so the ratio between the two is showing that growth is now outperforming value when we look at the discretionary to staples ratio. The Dow is still hanging in there. We're still above the 50 period moving average, but we're still below this pivot level, which is providing overhead resistance. The diamonds remain neutral for the Dow. The NASDAQ also still above this pivot level and looking okay so far. NASDAQ 100 also showed some improvement, up a little more than 0.25%. If we continue to go up, we'll be watching this 61.8% retracement level. However, internally, we're still seeing weakness with the cumulative new highs, new lows. They are continuing to decline. And when we take the new highs minus the new lows, we continue to be below zero. We're also watching this level, going back to a previous high with the NASDAQ 100. Support is still holding so far, but we're not really going up and testing this level again, at least yet. The Elder Impulse system for the Qs has switched back to positive. And the BPI for the NASDAQ 100 turned up slightly. Again, I've been trying to point out, David Keller from StockCharts.com thinks that this is a major signal. I don't necessarily see it that way, but I'm glad that we're keeping an eye on this because it could turn into a major signal. The NASDAQ 100 still above the 61.8% retracement level. If we fall, we'll be watching that for potential support. Small caps also still breaking out, holding above this pivot level, but not able to get up into this other area that had been providing support. Well, now it could be providing resistance. And the small caps continue to be positive with the Elders Impulse system. Looking at the Russell 2000 index with the RSI, we crossed above 50, but we're still negative with the MACD. The small caps ticked up just a little bit compared to the S&P, but continue to underperform overall. And then looking at the small cap index, we ticked up just slightly when we compare growth to value, and it's in an overall uptrend. Then the mid caps also staying above this pivot level and looking more positive after generating a recent golden cross. The Elder Impulse system for the mid caps remains positive, and we're also continuing to advance when we compare mid cap growth with mid cap value, and it's in an overall uptrend. This is one of the stronger areas of the market currently. The home builders ticked down just a little bit after just going parabolic here. Our ratio still continues to be positive, and the relationship between the home builders and the S&P is still quite strong. A broader look at the market by comparing the S&P 1500 to shorter-term bond ETFs, we ticked back up slightly in Wednesday's session. Another broad market measure also showing some improvement with further out bonds. The tech sector also bouncing back up after coming down to this blue line, which is a 20-period moving average of the ratio. And the home construction ticked down just slightly, but still continues to be very strong when compared to 3 to 7 year bonds. The S&P is also still anticipating a soft landing, which goes more hand in hand with that Isabel net chart that we saw earlier. Growth is bouncing back up when compared to value. Keeping an eye on the financial sector, down about 0.25%, down to the 50-period moving average, and we continue to be in a downtrend. And the financials continue to underperform the S&P. The regional banking ETF actually ticked up slightly, but continues to really be underperforming the financial sector. Keeping an eye on bonds, we were down based on yield and up based on price. This is also a concern. We're seeing this ratio continuing to go up overall when we compare cash with the 3-month bond ETF. If the market was more certain about interest rates and felt more confident, this ratio would be going down. Instead, it's going back up. We're also still above the 3-month yield, going back to 2007. We're just wondering, is this telling us that something negative could happen into the future? Our long-term analysis, this is another Isabel net chart, and this suggests that we are still in a long-term secular bull market. Then we're also seeing more positive price action, so on a cyclical basis, we're switching back to looking more positive as well. The special K on the daily chart continues to look more positive, where the special K on the weekly chart continues to look more negative. An update of our possible positive scenarios. We're still above zero based on price and volume with our 19-day exponential moving average of the advanced decline ratio inside the S&P 500. Looking at some growth to value ratios, the Qs turned up just slightly compared to the S&P, saw a little bit of a bounce with discretionary to the S&P, and a little bit of a turn up when we compare large cap growth with large cap value. The large caps showing some improvement, a bit of improvement with the mid caps, and we're showing a little bit of weakness now with the small caps. Looking at the percent of stocks in the S&P that are above their 200-day moving average, we're coming back up a little bit, and we're currently giving a reading of 58.4. Anything that's 50 or above continues to lean more positive. The S&P to utilities ratio continues to go up, and often this can give some good support to stocks. When we look at the broad range of the 5-period moving average of the highs minus the lows, we continue to be below zero. But when we look at the 10-day average of the S&P 500 highs minus the lows, we are still getting a really positive reading. Then looking at the 50-period exponential moving average of the highs minus the lows, we're showing some improvement because the indicator itself is still above zero. But this is another area of concern. When we compare S&P growth to value, we are declining even though we're in an uptrend. We had been chopping sideways, but now we're starting to see more weakness. When we look at the staples to S&P 500 ratio, it did decline a little bit, and often this can give really good support to the S&P. So what's our outlook for Thursday? The technicals are positive. They're showing some signs of improvement, but we're also seeing some negative signs all at the same time. This part hasn't changed as the market is really indecisive right now. The economic reports coming out on Thursday are weekly jobless claims. We'll get the first quarter third estimate of GDP. This is usually not a real big market mover unless it comes out really different than what we saw last time. And then pending home sales will also be coming out. Geopolitical events. We're keeping an eye on Russia. There's still some real uncertainty about what's going on in Belarus. That could escalate more, especially if it seems to threaten NATO, and that could drag this whole conflict to a higher level. But the market's still concerned about inflation and interest rates. Here is the updated version of the economic calendar so far for the week. And then Jerome Powell will also be giving another speech on Thursday in Spain. Looking at the Stock Traders Almanac statistics, we tend to be neutral to negative for the Dow, where we're looking more positive for the S&P 500 as well as the NASDAQ. Then we are now on the 20th trading day of the month, where the hope is that we're coming into a few days of positive seasonality in the past has provided support for the market. Then also, we're still looking at positive seasonality for the NASDAQ, which tends to do well until the middle part of July. So our scenarios, it's hard to go with the down one right now because our technicals are still positive, showing a little bit of improvement, but at the same time, we're showing some negativity as well. Hard to go with the up one because our trend is getting weaker, but we would default to the positive side because the green line is on top. But we're not going with the sideways trend for right now because the ADX, even though it's coming down and it's dropping below its moving average, both of them are still above 20. And the green line is now declining. So our warning signs, the parabolic SAR is negative. The BPIs are diverging, but still the S&P 500 BPI is holding up. It did not decline at least all that much on Wednesday. The VIX is still showing that there's not a lot of fear. The NASDAQ cumulative new highs and new lows continue to show weakness. We're still above the 3-month yield one going back to 2007. Earnings season can be either positive or negative depending on who is reporting. Positive signs, we still have the seasonality and setups that are in the background. The long-term special K on the daily chart is positive, where the weekly chart it's turning negative. The long-term equity put-call ratio is turning more positive as it continues to decline. The Pring bottom fisher still generating a buy signal. The S&P remains above the downtrend channel upper line. I haven't been showing that chart since we're far away, but we're still above that upper line, so we remain positive. We're still in a risk-on posture. Lower price levels may provide support, which could be a fib level, a moving average, a previous high, not only in the S&P, but also in other indexes, and so far, all these support levels have held. The S&P is outperforming utilities. The NASDAQ and NASDAQ 100, they continue to be fairly strong, but there is significant overhead resistance, especially with the NASDAQ 100. The staples to S&P 500 ratio is declining, which can give support to the S&P. The mid-caps are also looking a little bit stronger right now, especially when you compare mid-cap growth with mid-cap value, which is my next point. But still, small and mid-cap growth continues to be positive. Our conclusion, the S&P, same thing. It's positive, showing some signs of improvement, but still showing some signs of turning more negative. In the short term, we are seeing an improvement there. Intermediate term, we're positive, yet this is where we're getting more of the mixed picture. There are some negative signs and there are some more positive signs. Longer term, though, we still remain positive. Thank you. I hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.